Stop this right after a win. The Victory Hangover Trap. Why you give back profits. You think your last win makes you sharper. It mostly makes you reckless. On Mind Over Markets, we show how the Victory Hangover loop silently inflates risk after a green trade, then taxes your next 10. Keep your current habits, and you will keep giving back hard-earned gains in one impulsive press. Adopt the protocol today, and you will protect base size, feel decision calm, and let edge play out. The trap hides in how dopamine blurs danger signals and nudges position size and exit patience. You feel untouchable, then chase, then ignore your stop. Today, you will install one rule, one 90-second ritual, and one circuit breaker that stops the spiral before it starts. Before your next trade, pause for 3 breaths, read a one-line risk statement, and set a hard cap on size. Stay to the end for a drill you can run today. Let us name the problem so you can see it when it shows up. The Victory Hangover loop is a pattern where a recent win changes how you perceive risk, nudges your attention toward reward, and quietly edits your rules. After green, your base size feels small, your stop feels optional, and your next setup looks better than it really is. You move faster, you hold longer when price moves against you, and you feel a subtle pressure to prove the win with skill by repeating it immediately. The loop leaves fingerprints you can spot. Position size creeps a little above plan. Timeframes compress, and you drop to a lower chart to justify action. You widen exits after entry because you feel certain the market will come back. You chase a move that already went because you do not want to miss the sequel. And you ignore or delay the stop you would have taken if the last trade had been a loss. The cost is not just one red trade. The cost is a chain of oversized, low-quality decisions that hand back multiple sessions of progress and replace decision calm with agitation. Your equity curve gets more jagged, variance increases, and you start to doubt your system even though the system was not the problem. Run a quick self-check right now. Think about your last 5 trades. Did your size increase after a win without a written rule permitting it? Did you take a marginal setup within minutes of a winner because you felt momentum in your body? Did you hold a loser longer because you felt certain it would redeem the last triumph? Did you skip a pre-trade checklist because you believed you were in the zone? If you answered yes to any one of those, the loop is active. The fix begins with naming and noticing. Start a one-line journal for the loop today. After each trade, write a single sentence that records size versus plan, checklist done or skipped, time between trades, and whether the last result was a win or loss. This simple line gives you a mirror and a meter. When the line shows size creep, checklist slippage, or acceleration after wins, you will know the loop is steering, and you can move to the rule, the ritual, and the circuit breaker that reset control. Here is what research suggests is happening under the hood when the Victory Hangover loop takes the wheel. After a win, the striatum releases dopamine that highlights cues of opportunity and quiet signals of caution. The prefrontal cortex, which handles planning and rule enforcement, temporarily downshifts under that chemical surge, so rules feel optional and shortcuts feel smart. The amygdala tags new risk as less threatening because the recent reward is still echoing in memory, and the body rides a mild stress high that speeds decisions. In this state, you are not simply confident, you are biased by chemistry that makes speed and size feel safer than they are. Outcome bias then creeps in. Because the last trade ended green, the brain gives more weight to the result than to the process, and you start to trust whatever you did most recently regardless of sample size. Add the hot hand illusion where recent success is mistaken for a streak with predictive power, and you get a quiet permission slip to increase risk without evidence. Loss aversion does not disappear here, it mutates. You become more willing to risk a deeper drawdown in order to avoid the discomfort of giving back your new high watermark, which is why stops slide and profit targets stretch. Cortisol and adrenaline may still be present from the prior trade, so the body feels primed to act, which the mind then rationalizes flow. The net effect is a brain that rewards urgency and punishes patience right when patience would protect your equity curve. To spot the mechanism in real time, listen for 3 signals. A surge of certainty that feels physical. A pull toward faster charts or more frequent checks. A shrinking of the checklist because you believe you already know. When any one signal shows up, label it Victory Hangover out loud in a calm voice, pause for 3 slow breaths, and read your one-line risk statement before you touch the keyboard. In the mid-1990s, a young derivatives trader in Singapore turned a sleepy bank into a headline machine by stringing together a run of profitable trades that looked effortless. Nick Leeson was celebrated for finding basis gaps and small arbitrage mismatches in the Nikkei and related futures. The wins started small, then grew, and with each green streak, his autonomy expanded. Managers back in London saw the profit and trusted the wizard behind the curtain. That is the setup. The pressure arrived when a few trades slipped and small errors piled up. Rather than book the loss and reset, he felt a physical pull to make it right immediately. The victory hangover loop was already in place. Recent success had taught his brain that speed and size felt safe. So he moved faster, added size, and opened a secret account to hide losses he believed he would erase tomorrow. The first mistake was not the bad trade. It was the quiet rule edit that followed the win streak. Reporting lines blurred. He was allowed to run both the front office and parts of the back office, a violation that removed circuit breakers he would have needed. With that constraint gone, the next mistake was doubling down on losing positions because past wins told him he could trade his way out. Each time a loss stung, he remembered the glow of earlier wins and reached for it, adding to losers and pushing size beyond planned limits. The loop rewarded urgency and punished patience, and the system that should have demanded small cuts and clean books instead applauded big numbers and asked fewer questions. Then came the cascade. A shock move in the Nikkei during an earthquake stretch turned manageable losses into a hole. He added again, hoping to catch a bounce and stage a hero recovery. The hidden account deepened, margin calls loomed, and the mental math shifted from risk to survival. The more losses grew, the more his mind clung to the identity of the invincible winner he had been only weeks before. That identity demanded more action, not less. At the turning point, the brain reinforced the memory that breaking rules had worked before. The system required the opposite. Take the loss, disclose the exposure, cut size to base, step away. He chose the memory. Aftermath arrived brutally. Bearings collapsed under the weight of the positions and the losses hidden in the error account. The institution with centuries of history vanished in a weekend sale. The story is not only about fraud or poor oversight. It is a map of a cognitive trap. A run of wins created an internal permission slip to change size rules, skip dull checks, and assume that the next day would be another day to make it back. The platform of controls that could have saved the firm was removed piece by piece the moment the wins started to feel like proof of genius. Now the counterfactual. First, a hard separation of duties and an automated circuit breaker would have prevented the spiral. No trader should control settlement and confirmation alongside execution. That separation is a cognitive seatbelt. It catches victory hangover by forcing an external review when size or drawdown metrics shift. Second, a rule that after any above-average profit day, the next session starts at half base size with no averaging losers would have slowed the feedback loop long enough for accuracy to return. Nothing dramatic, just a modest break on a hot hand. Here is the rule you can steal today. After any green day above your typical profit, the next session must use base size only, no scale-ups, no adds to losers, and all entries must pass a written pre-trade checklist read out loud. If any box is unchecked, you do not trade. We're going to install 3 pieces that work together like a safety harness. The rule keeps you inside the lane. The ritual puts your mind in a steady gear. The circuit breaker stops a slide before it becomes a spin. Here is the rule in one line. After any above-average green day, you trade the next session at base size only. You do not scale up, you do not add to losers, and you must complete a spoken pre-trade checklist before the first order. If any item is missing, you do not trade. This rule is binary on purpose. It removes wiggle room at the very moment your brain hunts for loopholes. It also converts a vague feeling into a clear choice that your future self will thank you for. Now, the ritual. Set a 90-second container you run before every entry and before any manual exit. Sit up, place both feet on the floor, and breathe 3 slow cycles with a 4-count in and a 6-count out. As you breathe, read a one-line risk statement. Today, I protect base size and accept that a stop is proof of discipline, not a failure. Next, glance at your checklist and touch each item with your finger as you say it out loud. Is the setup valid by plan? Is the market environment supportive? Is the position size at base? Is the stop pre-placed? Is the take profit pre-placed? Then run a brief mental rehearsal. Picture the trade hitting the stop and feel yourself closing it without hesitation. Then picture a small win and feel yourself taking it without the urge to stretch. Finish with a 2-second pause where you look away from the screen and downshift your gaze. The ritual is short, concrete, and physical. It gives your prefrontal cortex a clear job. It slows the urgency that follows a win. It also raises the cost of impulsive action because you must actually skip a spoken line to break it. Now, the circuit breaker. You need external rails that do not care how you feel. Set a hard daily loss limit that locks you out for the rest of the session. Set a cool-off timer that blocks new orders for 10 minutes after any large win or large loss. Set a single trade size cap at base so the platform refuses any bigger order. Use a one cancels the other template so that the stop and the target are in the market the instant you enter. Add an end-of-day time lock that prevents new entries in the last hour, unless you are already flat and the setup is high quality by your written plan. If possible, give a trusted peer only access to your account history and ask them to message you if size or frequency jumps after wins. These are not signals of weakness. They are cognitive circuit breakers that turn a hot hand into a warm and steady hand. Why this trio works is simple. The rule removes choice where choice becomes dangerous. The ritual restores control of breath, attention, and language so that urges lose their grip. The circuit breaker covers the moments when the first 2 fail by creating a hard boundary in the environment. Together, they counter the dopamine surge after a win that downshifts planning and speeds bets. Together, they pull attention back to process over profit and loss. Together, they preserve decision calm when your body wants to speed up. When the loop tries to edit your rules, the card is there to reinstall them. Use an implementation ladder so this sticks. For 1 week, run the full trio in a practice mode with no live orders. Observe urges, write your one-line journal after each pretend trade, and tweak the words on your checklist until they feel natural in your mouth. For the 2nd week, go live at micro size and keep a simple metric. Count how many trades follow base size and how many checklists are complete before entry. If the completion rate is high and the equity curve is smooth, graduate to normal base size in week 3. If you notice slippage, hold your size steady and keep iterating until the behavior is automatic. Do not rush this. You are training a reflex. The goal is not to never feel a surge. The goal is to keep the surge from steering the wheel. Print a small rule ritual breaker card and keep it on your desk. The card reads, Rule, base size after big green, no ads to losers. Checklist spoken before first order. Ritual, breathe, read, check, rehearse, pause. Circuit breaker platform cap, daily stop, cool-off timer, one cancels the other orders, End-of-day lock, peer review. Copy that language into your journal and into a sticky note inside your platform if it allows notes. When you catch yourself wanting to skip any step, label it as Victory Hangover and recommit to the next breath. You will not eliminate all mistakes. You will reduce their size and frequency. That is how you keep the edge you already have. Here is your drill zone. You will run 3 challenges that train your reflexes and give you proof. First comes the 24-hour challenge. In your very next session, you trade base size only. You complete the spoken checklist before every order, and you enforce a 10-minute cool-off after any large win or large loss. If a setup appears during the cool-off, you take a screenshot, you do not trade it, and you review it later. You log a single line after each decision that records size versus plan, whether the checklist was spoken, the minutes between trades, and the result. Your aim for this day is simple. Hit 100% checklist completion and 0 adds to losers. If you miss a box, you stop, label it as Victory Hangover, breathe 3 slow cycles, and restart the ritual before touching the keyboard. Next comes the 30-day time frame challenge. Pick a fixed number of sessions that you will trade with the rule, the ritual, and the circuit breaker active. Set 2 core metrics that you can measure without guesswork. Track the percentage of trades taken at base size and the percentage of entries with a stop and a target placed at entry. Add 2 secondary metrics for texture. Track average time between trades and the count of cool-off timers triggered. At the end of each session, write 3 short lines. What was the clearest moment of decision calm? Where did urgency spike? What will I do differently next time? Every 7 days, run a quick review. Sort your screenshots and notes into kept rules and broken rules. Increase size only if kept rules outnumber broken rules by at least 3 to 1, and your drawdown over the week stayed inside plan. The third piece is the withdrawal or equity protection challenge. If you end the week above your starting balance, move a small fixed amount out of the account or into a separate pot labeled Protected Gains. This action teaches your brain that discipline leads to real-world outcomes and reduces the urge to gamble the high watermark. If you end the week below your starting balance, keep size at base and apply a simple haircut. Cut maximum daily loss by a small percentage until you log 3 sessions in a row with full checklist compliance. When the week ends, write a brief reflection that answers 3 questions. What rule saved me money? What urge tried to steer me? What tiny change will I test next week? Your action today is to commit in writing to day 1. Post a single number that marks your start and copy your 1-line journal template where you can see it. The work is not to feel fearless. The work is to make fear and excitement less influential than your rules. I hear the first objection already. If I cut speed and stick to base size after a win, I will miss the follow-through and leave money on the table. The truth is, you do not need to capture the sequel to validate your edge. Your system makes money across many samples, not by squeezing an extra % out of a single hot moment. When a move keeps running and your rule holds you back, you did not miss profit. You bought stability. There is a simple test. For the next 20 trades, tag any trade you would have taken if you had sized up. At the end, compare the equity curve you actually had with a hypothetical curve that uses those larger sizes. Most traders find the bigger curve looks flashier until one red bar erases all the glow. Second objection. This is too slow. Momentum requires decisiveness. The ritual takes 90 seconds I do not have. The ritual is not a brake on valid urgency. It is a filter against false urgency. 90 seconds is shorter than the average consolidation and long enough to let your planning brain come back online. If your setup cannot survive 90 seconds, it was not robust. Third objection. Rules kill creativity. In trading, creativity is selection and sequencing, not improvising exits while your pulse is spiking. Rules create the container where smart discretion lives. Final objection. I have proof that sizing up after a win boosted my month. Good. Now audit variance. Remove the top 2 and bottom 2 trades from the sample and check what remains. If the advantage disappears, you were renting luck. Keep the base and add size only after a 30-day period where compliance stayed above 95% and drawdown stayed inside plan. Here is how to fold everything into your day so the gains become habits and the habits become your edge. Starting now, your default day is simple. Base size stays fixed. The spoken checklist runs before every entry and every manual exit. The cool-off timer triggers after any large win or loss, and you respect it even when the chart tempts you. Your one-line journal follows each decision without fail. This is the today layer, not the someday layer. Add 3 fields to your journal so your data starts teaching you. Write the setup name by your plan. Record size versus base as a fraction. Note minutes since the last trade and whether the checklist was spoken. Tag each entry with win or loss only after the trade is closed so you do not bias the next one. At the end of session, capture 1 calm moment and 1 urge spike and 1 small tweak you will test tomorrow. Link this episode to the next topic by watching for the cousin trap that often follows Victory Hangover. It is the revenge ripple that shows up after a fast loss when you try to make it back. In the next script, we will turn that ripple into still water using the same trio of rule, ritual, and breaker. For now, pick one metric you will improve by 10% over the next month. Good options are percentage of base-sized entries or percentage of orders with stop and target placed at entry or average time between trades. Write your choice in your journal and begin today. Here is your next step. Download the Cognitive Trap Audit and Rule Ritual Breaker card from the link in the description. Print them or copy into your notes. Before your next session, fill out the audit in 3 minutes and place the card beside your keyboard. In the comments, post your start with the words Day 1 and your base size compliance goal. Share this episode with a trading partner who watches your risk and ask them to hold you to the cool-off rule for a week. If you want guided practice and live drills, join the Mind Over Markets Lab, where we run the checklist together and review real logs. No signals, only skill building. Remember, this is education, not financial advice. Risk is real and losses are part of the work. Your edge compounds when your rules survive both wins and losses. Start now, protect base size, and let decision calm lead the next trade.